How can you use equity to buy your next property? So in this video, I'm going to explain 3 examples of how you can use equity to buy property. The third example is going to be how you can use someone else's equity, your parents, family member, to gift you that equity so you can buy your first home. But the first 2 examples are for people that already own their own properties and want to buy more. Example number 1 is going to be you own your own home already and you want to use your equity to buy an investment property. Example number 2 is going to be you own your own home already. You want to use equity to buy another home and turn your old home into an investment property. And the key thing to understand with all of this is to know what the LVR rules are at the time of you trying to do this. The LVR rules are basically how big of a deposit do you need to buy a home or an investment property. Right now, you need a 20% deposit to buy an owner-occupied or a home and a 40% deposit to buy an existing investment property. There are certain rules for new builds, but I'm just going to simplify things and just say that it's 20% for home, 40% deposit for an investment property, because that's going to dictate how much equity you can get out of the property. You may think you've got lots of equity, but how much of it is usable? And in this video, I'm going to explain exactly how to calculate that. So make sure get a notebook, write down your numbers. And if you don't already follow me on TikTok and you don't listen to my podcast, please click below and do follow me there and start listening to my podcast, because we go into all these other topics so that you're going to be as clued up as possible about how all this property stuff works, but also to get updates as soon as I do with interest rates and rules. All right, let's get started. So example number 1 is you own your own home already and you want to use the equity to buy another property that is going to be an investment property. So what I want you to do is write down how much you think that home that you own already is worth. If you do not know how much it's worth, you can type the address into homes.co.nz or you can type it into OneRoof. For this example, I'm going to put down $1 million because it's a round number and I can do that number in my head. So $1 million property. I want to go check your mortgage statements and figure out how much money you owe against that property. Okay, write down that number. For this example, I'm going to put $600,000. So $1 million property value owing $600,000. So that's a difference of $400,000. If you were to sell that property today, you'd get $400,000. Now that $400,000 is equity. However, you can't use it. You can't use all of it because you have to keep 20% value in that property, because the deposit rules at the moment is 20% for a owner occupied. So you can only go up to 80% of that value, leaving the 20% there, which means you can go up to $800,000. It's worth $1 million, you go up to $800,000. So write down whatever 80% of your value is on your piece of paper. If it's a $2 million property, that means 80% is 1.6. I can't do any other maths of that in my head. So now from here, you need to subtract how much you already owe on that property. So for my example, $1 million property, I can go up to 800,000, but I already owe 600,000 with my existing mortgage. So I have to subtract that 600 from the 800. That leaves me $200,000. Now that is the usable equity. That is the money that you can use as a deposit for the next property. So you need to do your numbers and figure that out again. If you do not understand, rewind a little bit, start again. My example, $1 million property value, current mortgage of $600,000. Because it's a home, I can go up to 80% of the value, so $800,000. I already owe that $600,000 in mortgages, so I've got a difference of $200,000. Now, stage 2, $200,000. You can tell I'm wearing shorts. $200,000 can be the deposit for an investment property. If that investment property is an existing building and not a new build, you need 40% deposit. So that $200,000 is only going to be able to buy you a $500,000 investment property. $200,000 is 40% deposit of $500,000. If you're going to buy a new build, you only need a 20% deposit for that investment property. So the $200,000 can buy you a $1 million new build investment property. Now, with all of these examples, I'm only talking about the deposit. The key thing that people forget about is servicing. So when you top up your mortgage, which is using that equity and buying another property, you need to be able to show the bank that you can service the old mortgage and the new mortgage with your incomes and the rental income. So in this example, if I'm getting $200,000 out on top of the $600,000 that I already owe and buying a property worth $500,000, that's $600 plus $200 plus I need another $300 to add to that $500,000 mortgage. So that means I'm borrowing a total of $1.1 million. I had to do the maths quickly in my head. 600 plus 200 plus 300, so 1.1 million. Can my income service that? For most people, that's quite a lot of income that you need. Of course, you're going to have your rental income to do that, but you need to make sure that the servicing rules also are ticked off, as well as the deposit rules. All right, it's probably a lot to process. So if that's your example, then stop watching now. Example number 2 is you want to buy a new home using the equity from your current home and turn your current home into investment property. So similar rules apply. You need to get a 20% deposit for this new home because it's a home. So if you're going to buy for $1 million, you need $200,000. If your current home is $1 million, because it's going to be turned into an investment property, you have to leave 40%, not 20%, 40% value because it's going to be an investment property. So if you had $600,000 mortgage against that current home, you cannot get any money out because you're already up to 60% of its value, leaving 40% in. If you owed $400,000 against $1 million property that's going to be turned into an investment property, you can go up to $600,000, leaving the 40% value. Now, there is a little bit of a loophole here. You can actually just do this at 2 different banks, and you might be able to get approved because at one bank, you'll go up to 80%. The other bank, you go up to 80%, but that does leave you over leveraged if you are going to be a little bit cheeky and do it that way. But going back to the example. So you've got your old home that is going to be turned into investment property, and then you have your new home that is going to be your new home. So you only need the $200,000. But again, you need to meet servicing rules. So you're going to have $1 million of new lending for the new home. 20% is going to be against your old home. 80% is against the new home. So that's $1 million plus whatever was owing on your other property. So that could be up to $1.6 million that you need to be able to service with your incomes and the rental income, which is quite a lot of money. So if you're unsure if you can service it, you can do the calculating on the bank's calculators to figure out what your repayments are going to be. If you think you can manage that, then you need to get in touch with me. There's a link below. You can book a little call with me, and we can assess it based on the bank's rules because they're obviously going to be more strict, more risk averse than you are. Example number 3, if you're waiting for this, it's because you don't actually own any property at the moment and you want to use someone else's equity to be as a gift to help you buy your first home. Now, the key thing with this, and hopefully you've realized from listening to the last couple of minutes, is that equity is not free money. It is a loan. So whoever is getting that loan needs to be able to service it. In most people's cases, the equity gift that they're going to get is from their parents. So let's say your parents own a house that has no mortgage on it, and they're going to gift you $50,000 to put towards your home. Because they own that home, they are the borrowers, and they are getting a $50,000 loan against their house. The bank is going to make sure that they can pay it back because it's against their property. So the bank is going to ask them, how much income do you make and how can you pay this loan back, especially if you're close to retirement? So that's usually the tricky part when you're getting a gift from parents that are securing it against a property, especially if they're near retirement or already retired. So keep that part in mind, and it might be better asking someone that's a bit younger to get the equity gift out because they're going to be more likely to service it because they've got more working years left. Now, the way that you could pay that back is weekly, monthly, fortnightly. However, if it is a true gift, it needs to represent a true gift so you don't pay it back, and the bank would prefer that. One caveat to this, though, is if you do need to pay it back, maybe you could write into the agreement that you pay it back once you've sold the property that you used it on, and therefore the bank would be happy to not view that as a loan that you're getting from a family member. All right, that's quite a mouthful, so I hope that helped you guys with equity. There is obviously lots of questions that I get around this topic, so if you have more, leave them in the comments below. As I said, I do short form videos on TikTok, and I've got a podcast. There's also a link below to book a call with me. You need to fill out a form first, and if I think you qualify or come close to qualifying for a mortgage, then I will give you a call back myself.